So, throughout the last few days, you will probably come across my content, referencing the downfall of China's entire economy, how it's positioned to collapse in the next few days, and why the debt crisis is spiraling out of control. The several points I have covered in my previous video, and if you have watched that, here is the link. So, let's start with an example. So the Chinese home developer might take out a loan for $50 million, spend $25 million buying a new property to collect even more pre-sale deposits, and then transfer the money to other countries or overseas, leaving the bank and the people on the hook for the amount unpaid. The Chinese government has agreed to repay their customers, the equivalent of about $15,000, but that will not be enough to get their customers to fully trust the banking system again, leading to the word that everyone fears a bank run. As already pointed by many YouTubers out, both the USA and China employ a system called fractional reserve banking, where a bank can keep only 10% of their customers' assets on hand at all times. The rest could be freely lent out or loaned to other institutions for a profit. Just imagine it like this: you give me a $2,000 to hold on to for safekeeping, but I'm allowed to turn around to give $1,000 of that to someone else, who gives $800 to someone else, and so on. Or in other words, they're betting that no more than 11% of their customers are gonna want all of their money back at the exact same time. But since 2019, China's been lowering these reserve requirements to allow for more money to be spent, which would temporarily prevent the economy from slowing down, but that comes at the increased risk of a bank run. Should more of their customers all demand their money back at the exact same time. This happening at the same time that their population has lost faith in the real estate market, has degraded consumer faith in the real estate market, has degraded consumer faith in the Chinese economy, and for the government to priorities is to break the negative back loop. That features the high leverage ratio and the liquidity crunch on the part of the developers. After all, if people don't trust banks, the less money is borrowed. If people don't buy, real estate developers walk away from projects. This then repeats the cycle to an even larger degree, while people pull money out of the system and protect whatever is left. However, the one thing that China's been really good at is delaying the inevitable through reimbursing some account signal, overseas transactions, and potentially bailing out bankrupt developers by lending even more. But it's not a good idea to use it as a solution to solve over-leveraged properties, as to simply loan more money to make up. But it's estimated that this new fund could raise all the way up to 300 billion yuan, which might be enough to restore confidence in the market and wait for the economy to recover. Someone already said on YouTube that this fund would bankroll the purchases of unfinished home projects and complete their construction and then rent them to individuals as part of the government's drive to boost rental housing. So don't think that all these are just for the Chinese market, or it doesn't affect here in the US or any other part of the world. That's not the case. As I've seen, the United States has substantially increased their investment in China throughout the last 10 years, and this includes many large institutions to regular everyday investors. And it's important to mention that even though we do have over $100 billion invested throughout China, it's still only a drop of water in the sea in terms of how large the US portfolio really is. But regardless, Chinese companies also hold a lot of exposure to the United States market, and when they need money, it would make sense that they would sell those assets to raise capital, which would result in a much more volatile stock market. The real impact, though, for everyone in the US is not a policy change or a drop in the stock market, but instead the investor perception that things could get a lot worse before they get better, or in other words, it's just fear. In the United States, for example, fractional reserve banking has been around since 1791, and it's backed by the code of the FDIC and regulation to ensure that banks aren't just going to be running off with their money. Now, I am sure you already know about 1920s Great Depression caused by over-leverage on bad investments, while entire cities wanted their money back. But throughout most of our lifetimes, this has not been something to worry about. Although in China that's not been the case. They've made it abundantly clear that their approach is to protect the market at all costs. But without strict oversight, it appears as though there are too many bad actors looking to take advantage of the current system, and that could simply delay the inevitable. It's too early to tell exactly how this is going to play out, but it's noted that China will fall short of meeting its annual economic growth target of 5.5%, and was starting to realize very quickly that the days of China's meteoric economic rise are long past in a perfect world. Guys, I want to thank you for sharing your support on the last video. If you want to be kept up to date with #1 content, make sure to subscribe and click on bell icon to receive notification.